While you sleep, the currency you hold is being eroded by a system you don't yet understand. Most people look at their bank balance and see safety. I look at it and see a melting ice cube. In the next 25 minutes, I am going to dismantle the greatest lie ever told to the middle class. The idea that saving money makes you wealthy. It doesn't. Mathematics never lies. And the math of the modern economy is designed to tax labor and reward capital. If you are working for a number that appears on a screen once a month, you are already losing. You are caught in the income trap. You are playing a game where the rules were written by people who do not want you to win. Today, we change the game. We stop looking for income and start architecting wealth. We are moving from the ego-driven pursuit of a high salary to the strategic accumulation of assets. Most people lose because of their ego. We win because of our strategy. Welcome to the protocol. Let's define the core problem. Why is it that the harder you work, the less you seem to keep? It's called the tax trap. When you earn a salary, you are taxed at the highest possible rate. In many jurisdictions, after income tax, social security, and indirect taxes, you are left with less than 50% of your productive output. You are working from January to June for the government. The wealthy, however, do not live on income. They live on wealth. There is a fundamental difference between a portfolio and a paycheck. In this strategy, we focus on 3 specific asset classes: cash-flowing real estate, specifically commercial or multifamily units, equities like broad market index funds with low turnover, and private equity or businesses, entities that generate value without your physical presence. My goal is to maximize the value of the asset while minimizing the taxable event. The cardinal sin of wealth building is selling. When you sell an asset, 2 things happen. You pay a capital gains tax and you stop the engine of compound interest. Let's look at the formula for compound interest. The final amount equals the principal multiplied by 1 plus the rate divided by the number of compounding periods, all raised to the power of the number of periods times the time in years. If you sell your asset after 10 years to realize profits, you reset that time variable to 0. You also subtract 20 to 30% of your principal in taxes. You have effectively murdered your future wealth to satisfy a present-day ego. The strategist never sells. We utilize the buy, borrow, die model. Step 1 is the transition from a person to a legal entity. Most people invest as individuals. This is a strategic error. When you invest as John Doe, you have no shield. The wealthy invest through holdings or corporations. Why? Because a corporation pays taxes after expenses. You, the individual, pay taxes before expenses. Did you know that 80% of the world's wealth is held through corporate or trust structures, not personal bank accounts? Let's look at the construction sector connection. Imagine you are developing a project. If you take the profit into your personal account, it's taxed. But if that profit stays within the corporate structure and is immediately reinvested into a new project, you can often defer those taxes indefinitely. You are using the government's tax money as an interest-free loan to build your next building. But how do I buy groceries if I never sell my stocks or buildings? This is where the Securities-Backed line of credit, or SBLOC, comes in. Instead of selling $1 million worth of stock and paying $200,000 in taxes, you go to the bank. You offer your $1 million portfolio as collateral. The bank gives you a line of credit at, let's say, 4% interest. Here's the mathematical arbitrage. If your asset is appreciating at 10% per year and your debt cost is 4%, your net wealth is still growing by 6%. Net growth equals asset appreciation minus the cost of debt. 10% minus 4% equals 6%. Crucially, debt is not income. Therefore, debt is not taxable. You have accessed $500,000 in cash to live your life, and you owe 0 in taxes on that liquidity. Now let's talk about tax engineering. In real estate, we use paper losses. A building might be going up in value due to market demand, but the tax code allows you to claim depreciation. You tell the government, my building is getting older and losing value. This loss on paper can be used to offset the actual cash rent you receive. The result? You have a building that is putting $5,000 a month in your pocket, but on your tax return, you show a $0 profit. This is not a loophole. It is the intended design of the system to encourage housing development. I wasn't born with a portfolio. 20 years ago, I was a waiter at a luxury restaurant. I spent my nights carrying plates of Wagyu beef to people who earned in an hour what I earned in a month. I watched them. I noticed they never looked at the prices, but they always looked at the receipts. They weren't checking the cost of the wine, they were checking if the meal could be categorized as a business expense. They were thinking in systems while I was thinking in tips. Later I fell into the ego trap. I tried dropshipping. I wanted fast money. This bias causes people to hold on to dead assets, bad properties or failing stocks, just because they don't want to admit a loss. This is a sunk cost fallacy. Then there's inflationary erosion. If you keep your wealth in cash, you are losing by default. If inflation is 5% and your bank account pays 1%, you are losing 4% of your life force every year. Your real return is your nominal return minus inflation. In an inflationary environment, being safe is the most dangerous thing you can do. Here is your execution plan. Do not summarize this. Act on it. Incorporate. Stop acting as an individual. Consult a professional to move your investment activities under a corporate or trust structure. Professionalism starts with your legal identity. Asset first allocation. 30% of your gross intake must go directly into appreciating assets before you pay a single personal bill. You are the last person you pay. Establish credit lines. Do not wait until you need money to talk to a bank. Build your portfolio and establish your lines of credit now. Liquidity is a weapon you keep in your holster. And finally, tax mastery. Hire a strategist, not just an accountant.